So for those of you, I think I know pretty much everyone on here, but for those of you who don't know me, my name is Dr. Jason Van Dyne, and I am the president and founder of Aquest Wealth and Tax Strategies. So we do these webinars, depending on what's going on, we'll do them twice a year, maybe as many times as 4 times a year. If the economy is moving in a lot of really drastic ups and downs, we usually do them quarterly. If not, we'll usually try for twice a year. So the one that we always do in January is just looking forward. Let's try and look ahead a little bit and see, see what we might be able to expect. So with that, I'm going to keep looking down on my phone here so I don't go too long, because as you know, I like talking about this stuff. But I'm going to shoot for about a half an hour, maybe 35 minutes at the most, so not crazy. And then I'll stick around and take live questions from anyone who wants to ask, as long as you want to ask them. So with that, I think we can get started. First, we're going to look at the economy. And then we're going to look at how that might affect the stock market and how that might affect the bond market. I think those are the three things that I always get asked about and that most people have the most questions about. So with that, we can go here. It's kind of the first page. I think it's kind of the first page is kind of a bummer, and I can promise the rest of the presentation is not going to be like that. But the economy is expected to slow down a little bit. The main reason is people have been blowing through their savings. The spending has kind of continued in 2023 like it did in 2021 and 2022. But 21 and 22 were just absolutely fueled with stimulus, right? Trillions of dollars of stimulus, both in low interest rates as well as in just pure dollars, right? Dollars coming into the economy. It's stimulus that some of you may have gotten, but also business owners. A lot of businesses, we're talking, got a ton of money, and that money has just been sitting there in bank accounts. So it's been able to support this really, really high spending. About 70% of the US economy is that spending. It's not businesses, it's not government, it's just us as people, spending our money. It's about 70% of the overall GDP of the entire country. So we think that the economy is probably going to slow down a little bit next year because people have been not only, I think interest rates going up have made their debt seem bigger, their savings account balances have gone down. When I say gone down, I mean by like a couple $1 trillion, pretty big money. And there's some leading indicators out there that are flashing some warning signs about people not paying their credit cards and their car loans on time. Usually when people aren't paying credit cards or car loans, that is kind of a leading indicator of bigger things that they might not be able to pay later. Credit cards are kind of the first thing you don't pay on time, and that goes, and then, mortgages are, for example, the last thing. So we expect the economy to slow a little bit. Does that mean necessarily that the stock market's going to go down? No. And I think a lot of people, unfortunately, kind of assume that if one is going to go up or down, the other is going to go up or down. And it's a lot of times not the case. One of the main things to look at, as I think for how the next year is going to go, both from the economy and from the stock market, is inflation. Because whatever inflation is doing is what interest rates are going to be doing. And interest rates, as I've been saying for the last 3 years, maybe even 4, are the most important thing in the economy, and that's been true this whole time. So when the government raised interest rates, what happened to the stock market? Down 20%, right? What happened when the government said we are going to kind of slow interest rates? Stock market up 23%, right? So interest rates have basically driven the whole economy for the last several years. And that's because of what you see on the screen here with inflation. So you can see just normal CPI is the dark blue, kind of the line that's not dashed. And that's getting down, to a pretty reasonable amount. The Federal Reserve wants it to be anywhere from 0 to 2%. But as you can see, it was up, it was at 9 for 1 month, at 9.1. It's already down into the 3s. So, it's certainly moving in the right direction. That's why the Fed signaled about a month ago that they're going to decrease rates at least 3 times this year. If I had to guess, it's going to be closer to 5. But they publicly said that they're probably going to decrease them as many as 3. Interestingly, in here, services, right? The service inflation, this blue dash line, has come down, but look at, it's nowhere near as drastic as stuff. Orange is durables. Durables is stuff, right? TVs, cars, things like that. 2x4s, right? I don't know if you remember that 2x4s 2 years ago were like quadruple the price they were, the year before, because everyone was building and adding onto their house because they had so much extra money doing renovations. So interestingly, durables, which is stuff, is actually below 0, meaning that the price of stuff is shrinking. That's great for the economy, right? It was way too high. We need to get services down a little bit. I think that will happen in the next year because what's been really high that's driving services is travel, right? So air and hotel has been super expensive, and that's really raised the price of services. So I think as those come down, the services will come down, and I think you'll see inflation. You'll see a slide later on about it today, but we'll get way more in line with what we want, which would be wonderful because then the government will start reducing interest rates, which in a bad economy or a economy might actually drive the stock market up. Like I said, they're not always attached. I'll just go over this one very quickly. I thought it was kind of interesting. This is the wage growth. You can't have wage growth at 5, 6, 7, 8%, right? That's going to drive inflation, and that's actually very bad for the economy. You don't want wages necessarily growing that fast. So wage growth of here, I think at 0 to 1%, that's not great either. But, somewhere in here between 2 and 3, I think is great, right? So if you can be, if you could be here or maybe even here, like the lower end of this, I think that's great. This is way out of bounds, and you see that starting to come down a lot. You'll notice what's coming down faster than the blue is the job switchers. So a lot of times when you switch jobs, right, you get a raise or you get a promotion at your job, then quit and take that promotion and bring it to the next place and go get another raise. So you can kind of double it. That was incredibly common and popular, right, for the last couple of years because unemployment was basically zero. So you could go switch jobs. Your people were going to pay you a little bit more, and that number's coming down a lot, which tells me that the economy is getting more healthy and more typical. Because these job switchers should not be able to get an 8, 9, or 10% raise just for switching jobs and doing the exact same job. So that's another really good sign for inflation. Again, where inflation goes, interest rates goes, and that's going to drive the whole market. Also, the amount of part-timers. So you could see here in times of distress, like this is 08, the 08 crisis, people got rid of all their full-time employees, or at least didn't hire any more, or sometimes both. So the amount of part-time employees went way up. It was a quarter of the workforce, which is a lot. Right, which is a lot. It's usually about just under 20%. And same thing is here in the 90. In 1990 at that recession, you had an uptick in part-time people. In the 01 recession, right, September 11th, and the tech bubble bursting, you had this jump of part-time employees. In 08, you had a huge jump of part-time. In COVID, you had a big jump of part-time. And now, again, we're here, and you're seeing this number. It's not jumping up because we're not in a recession, but it is trending up, which is recessionary. Right. So that is maybe a leading indicator of a potential recession because that number is trending up. Again, as long as it trends up and doesn't spike, it might actually be good in today's environment. We're still a little bit below the amount of total part-time workers. And what we want is we want full-time workers to know, no, you're not going to get an 8% raise this year. You're only going to get 3 because inflation is back down to 2. And if you're not willing to accept that, job switching is not that valuable anymore. And we can hire maybe some part-time work to replace you. So that's actually, as long as that doesn't spike, that's probably in today's market where we need to be disinflationary. It's probably good for the economy as a whole. So here, as you can see, is the estimated GDP growth and CPI. So the U.S. they're only estimating 1% in growth, which is low, right? We want to try to get that number to a good 2.5%. 1% is pretty low. But again, maybe that's okay because if growth is slow and inflation is low, the Fed will feel very comfortable lowering interest rates, right? Because the economy is not overheating. So as the Fed lowers interest rates, it drives profitability in companies, which drives the stock market. So a growth of 1% this year might not be that bad. I'd love to get closer to 2 and 2.5 maybe in the next couple of years. But a growth of 1% this year will probably give the Fed the cover that it needs to lower rates relatively substantially, which will be wonderful for the stock market. And they think that CPI or inflation is going to be at 2.8. The Federal Reserve is going to say they want it from 0 to 2, but they'll take 2.8. It's a lot better than 9, right? Which is it was about a year ago. So I think at 2.8, the government clearly sees it's gone from 9 to 2.8. It's moving in the right direction. And again, lower some interest rates. Interestingly, is this. If you look at the GDP growth of emerging and global companies, it's much, much, much higher than the U.S. Now they're going to have higher inflation as well, so the real growth, right, is maybe not as impressive as it looks. But I think if you take the GDP growth potential of some of these emerging market and global companies, and combine that with the fact that as interest rates go down, the dollar is also going to go down. if interest rates and the dollar both go down, and international companies are growing more or more quickly than the US and their economies are growing faster, I think almost across the board, people that we meet initially are kind of under allocated into EM and global, emerging market and international. And it might be a good time to make sure you've got a strong allocation of that, because the growth for those as the dollar goes down, again, should look pretty good to us, right? Because we buy things with dollars. All right, so for the stock market, the first slide I thought was interesting, but I don't know how much weight I would put in it. What this shows is what they call bull markets. Bull market is any time that the stock market is up 20%. So here's the last, handful or two of bull markets. And you can see kind of what the first year did is usually awesome. The second year is usually okay though, right? A lot of people say, well, what about the election? The election is much, much, much less important than things like this, which is why I'm not even going to talk about it today. We might at the mid-year one, or if there's a lot of volatility and we end up with doing one after the first quarter, we might talk about the election, but there's a lot that's going to happen in the next couple months before we really can dig too far into that. So what this is saying is that based on the market last year going up so much, that if you kind of figure out mathematically what the second year should be, they're saying kind of the top end of what we anticipate any stock market growth being this year is 12.6%, right? So that's right here. So I think for our conversation today, that's kind of the maximum, right? No one really thinks the market, at least LPL and their research department, they don't really think that the stock market's going to go up much more than 12%, which considering economic growth might only be 1 is actually pretty good. You'll see later in the slide that that earnings are also probably going to be up 7 or 8, but not 12. So with slow GDP growth and okay earnings growth, 12% would be, I think, on the high end of what we would expect. So with that, let's get into kind of some earnings. So you could see the earnings over the last couple of years have just exploded, right? I mean, in 2019, before COVID, the earnings, which is the profit per share. So if you took all of the profits of a company and then you divided it by the millions of shares that you have, what is your actual profit per share? In the S&P, if you add up the 500 S&P 500 companies, you get $159 a couple of years ago. We're anticipating that to go to 235, right? And that's just in 2024. That's only in 5 years. So in 5 years, what kind of growth is that? 75, that's 45%-ish or so growth in the profit of the biggest companies, basically, right? That's a really, really high number, and that is kind of that is also considering this growth was all driven, from 20 to 21 was all driven by stimulus, right? The government stimulated the economy like crazy. They made interest rates 0. They put money in the pockets of consumers, and everyone went and spent it. So companies just made money hand over fist. For the last 2 years, you could see it hasn't really gone up much. And the reason is inflation. So companies were still selling a ton of stuff, but it cost them more to run their business, right? So their profit, their earnings didn't really go up that much. We saw that. We saw that at our company, where stock market was down, so our earnings were down, but all of the employees were like, hey, everyone I know is getting an 8% raise. I'm going to need that this year. So our cost of business was going up, but our revenue was actually going down at the same time. A lot of these companies, what you could see here is that their earnings stayed relatively stable in the face of inflation. So even though all of their cost of business was up, they were able to charge more, right? We all paid more, right? And that's what was so inflationary. So what they're saying this year is going to get back to kind of more of a normal, right? There's going to be normal inflation. There's not going to be any stimulus, and companies can kind of get back to about an 8% increase in their earnings, which is incredibly consistent with what you've seen over time. So that's very good.
Jason. Question?
Yeah, go ahead.
Oh, did you want, not to interrupt you want to save the questions?
Yeah, Joe, do you mind can you jot it down and just write it at the end?
Yeah. Okay. I didn't know what the format was. Okay, go ahead.
Okay, thank you. So I think earnings are going up, which is good, and they're not going up way too much, which is actually kind of bad. They're going up, I would say, a very healthy amount. So target value, everyone always asks these, so we throw them out in the beginning of the year. The S&P 500, when they started to put this together, was at 4,500. It's actually at 47 now. You can see that they're only estimating it to go, between 48.50 and 49.50. That's not that much more growth, really, quite frankly, from where we're at right now. So again, where you saw in the very beginning, you said, hey, the upper range is going to be about 12.6%. That's just based on how the markets have acted historically, right? Considering where we are with like kind of COVID boost, COVID bust, and then inflation, right? I don't know that we're in like a typical or a normal, you know, market cycle. So I put more weight probably personally into this than I do into the first slide. So I would think that this that shows kind of like middle of the road growth for the year, let's say mid single digits, maybe upper single digits, 5 to 8%, is probably reasonable. And one of those reasons is earnings. The market's already high, right? We're actually almost exactly within 10 points of the S&P 500 of being exactly at the height of the market where we were 2 years ago, a little over 2 years ago. So over 2 years, the market's been down 20 and then up 23. So it's almost exactly at zero. But as a result of the huge growth last year, stocks are now relatively expensive. As a result of that, even with pretty good earnings growth, the stock market already thinks that earnings growth is going to happen. So if we don't get it, you'll see the market drop. And if we do get it, you'll see it go up a little bit because those numbers are kind of already cooked in. You can see kind of the upside midpoint, or where they think is an average, like I said, upper to mid single digit returns for the year. So for those of you on here that work with us, and a lot of people rewatch this on YouTube and other areas that are not necessarily clients of ours, you'll see that a lot of what we do is reflected in this, right? What we've done a lot in the last couple of years are more like structured products where, you know, there's a maximum cap, right? And you can't earn much in excess of that, but you protect it on the downside. Well, all of the caps are over this midpoint, right? So the idea being, if you have a decent year, you're going to capture all of it. But if that doesn't happen, which there's some scenarios we'll talk about later, if it doesn't happen and the market goes down, right, then you're at least protected, right? So a lot of the investing that we've done in the last year or so is very reflective of this, and we will continue with those kind of thought processes, you know, throughout this year, I would suspect. All right, so for bonds, we've got Treasury yields, Treasury forecast. No one understands bonds, right? So whenever I talk about bonds, people always look at me, they're just not familiar with it. The bond market is huge, right? I mean, the bond market's almost as big as the stock market. It's not a little bit bigger depending on what bonds you include. But no one really understands how they work. What I would say is this is the 10-year Treasury, you can see this number right here, 10-year Treasury is the most important interest rate in the entire world by a mile. There used to be one in England called the LIBOR that was also very important. It's not anymore. They actually did away with it completely because it lost its stature. So this 10-year Treasury yield, to everyone who's going to listen to this, is probably the most important interest rate. The one the Fed controls, by the way, is very, very short-term in nature. The Fed actually controls something called the overnight lending rate, which means when a bank lends out a bunch of money that day, they might not have enough money in their vault. I know it's all electronic now, but imagine it as a vault. They may not have enough money in their vault to satisfy what's called the reserve requirements, basically making sure they have some money there in case you want to cash a check, they actually have the money. So when banks don't have enough, they had a good day lending out money, they don't have enough in their vault, they can call another bank or the Federal Reserve and borrow that money. The thing is they have to pay it back the next morning, right? It's literally an overnight one-day lending rate. So it's very, very short term. It's the shortest term interest rate there is. That's what the Federal Reserve controls. The 10-year Treasury is what life is based on. Mortgages, home equity loans, student loans, credit cards, car loans, everything that we would potentially borrow money for, business loans, businesses borrowing billions and billions of dollars, right? They're all based on the 10-year Treasury. Bond prices are basically based on the 10-year Treasury. So it's super important. So we think that there's kind of 3 different scenarios here, and I'm going to spend a little bit of time on this because I find this very interesting, and I think it adds more color to what we talked about. So if there's a recession this year, which again, a recession is just a contraction of GDP, right? Gross domestic product. Doesn't mean the stock market necessarily goes down. But if we get a traditional recession, the economy actually contracts a little bit, does not get the 1% growth that LPL is estimating. As the economy is going down, inflation also goes down. So the Fed cuts rates relatively drastically. All of that means global bond yields fall, right? So this 10-year Treasury today is at around 4%. 2 months ago it was at 5. 5 to 4 is, it's a gigantic move in interest rates. It's so big. So 5 to 4 is a huge move. From 4 to 3.25 would be another huge move, right? So, you know, I would think that the Fed funds rate that they control is today at 5.5. It goes all the way down to 3.5. if that happens and we're in a little bit of a recession, the economy might not look great, right? Meaning people aren't getting big raises. You might see some layoffs. Unemployment will probably go up a little bit. But for those of us who are working and getting a little bit of a raise and have money in the stock market, that's fine. It affects negatively, which I feel bad for them. It affects the people that get laid off, but everyone else who's working in this quote unquote recessionary environment is probably going to do better because they're going to be able to refinance their house. They're going to be able to get some relief on their credit cards and student loans. They're going to be able to go buy a car at a better rate. And they're going to do all of that while the stock market's going up because we are in a recession, inflation is low, and the Fed lowers rates a lot. And when the Fed lowers rates, it's very good for the stock market. So a traditional recession, even though it sounds bad, is probably good for almost everyone on this phone, or who's potentially listening to it after. I also don't dislike the flattish growth and mild recession. It's just going to lead to a very meh year, which I'd like to get a little north of meh, right? Like I said, closer to that 7.5. So, the macro conditions are the economy still grows a little, kind of like LPL's estimate of 1%. Inflation expectations are going down a little bit, but not that much because the services are still a little too high. Fed cuts rates, but not as much. Like you see, they only cut it from 5.5 to 4.5. That would be bad, right? That would mean they're not cutting it that much, and interest rates are still very constrictive on the economy. And you'll probably see unemployment stay steady. Like the unemployment market would be actually too good. People would be getting raises that are a little bit too big, and the Fed would worry about inflation becoming what they call entrenched, meaning that people just expect inflation to last forever now at 3 or 4% instead of 0 to 2. That would be bad for the economy. And the Federal Reserve is not going to screw around. They got caught with their pants down a couple years ago, right? And they're not going to do that again, right? So they're going to keep rates higher if there's any sign that inflation may become entrenched. So this is, I actually think, kind of a bad, like, I would hope to not see this. I want the Fed to cut rates by a little bit more than that. At the end of the year, be closer to 3.5 or 4. And if that happens, then I think we can get stock market, 7 to 10%. This is a stock market that is not doing that great, right? Maybe up 4, 5% for the year, and then reaccelerating. So if the economy actually picks up too much, it means people have too much money. It means the economy is going to be hot. It means inflation is going to be high. The Fed, they actually state that the Fed could actually increase interest rates because they'd be so worried that after an inflationary period, it kind of leveled out and inflation is going up again. The Federal Reserve will react to that. Again, Powell got very embarrassed a couple of years ago with his with kind of how he dealt with a lot of saying that inflation was transitory. You remember all of that talk? That was clearly wrong. They were way too late on raising rates, and it was bad for the U.S. economy. He's not going to do that again. They've been pretty clear on that. So if the economy, so we don't want the economy to pick up too much, because that could be potentially inflationary. And again, everyone might have a job, and you might get a little bit better raise than otherwise, but I think that would be bad for the stock market. And I would suspect the stock market would actually go down, probably mid-single digits to maybe up to 10% if that were the case. So with that, our interest rates, I get asked this all the time, which is why I put this in here. Our interest rates, high? Are they low? Are they kind of normal or average? So this is the at the 5% 10-year treasury right now, we're high. Actually, we went from 5 to 4, right? So we're relatively high now. But it's on the high end of normal, right? It's still pretty normal. That's why I would expect this to come down a little bit. If this comes down a little bit by the end of the year, again, kind of like this scenario or in between these two scenarios, that's the Goldilocks zone, right? If the Fed lowers rates from 5.5 to 4, that's a big move. That's going to drive the stock market up, right? So we don't need interest rates to go through the floor, but if they come down a little bit, right, a little bit, and the 10-year treasury comes down a little bit, not only the stock market will do great, but also the bond market, I think, will do great. So, and that I think is kind of the Goldilocks zone. So with that, I mean, quite frankly, usually we get a ton of questions at the end. So I always want to leave a ton of room. That was only 24 minutes, so that's pretty good. So with that, I'll just kind of open it up to questions. I know, Joe, you had one. If anyone else jotted anything down that they have, just kind of chime in. But Joe, why don't you go first?
Okay, thanks. Regarding government stimulus, that was kind of one of the major factors of causes of inflation, correct?
Yeah.
Yeah. Okay. And I'm not sure what it really bought us in the end, other than maybe trying to keep the economy moving a little bit. But so if we don't see anything really that extreme in the future, we shouldn't have that extreme spike in inflation again, right? Or could there be other reasons why we could see a spike to that level?
No, I don't think it would be. I mean, to that level would be like back to where you were at like 9%. I think the chance of that happening is almost zero. There's just no impetus for it at all. Um, usually you got to have some economy doing awesome to get that. And that's not happening, right? I mean, even China's in the toilet. So a lot of the natural resource stuff, lumber, copper, zinc, all of that is coming down because China's not growing at all, right? They went from growing at 10% a year to like, they say 5 to 7, it was probably 2 or 3. So China's growth is basically zero. They're going to have a big property problem, right? They've got a ton of debt. So China's not going to drive it. If Europe hasn't grown fast in 30 years. Japan hasn't grown fast in 40 years. So minus a huge stimulus, I just can't see inflation getting back to 9. The problem is if it stays at 4, right? If it stays at 4, the Fed's not lowering rates. It'll be bad. Then the bond market will again have an only okay year. The stock market will have an only okay year at best. So if inflation stays even mildly high, let's say 3.5 to 4, I don't think it's going back to 9. But if that happens, that will not be great for the stock market or the bond.
Okay. That helps. That was a great slide with showing the bond comparisons and the market performance and all that. That was really good.
Thanks.
Good job. Okay.
Appreciate
that's all I had. Yep. Next.
Yeah. So anyone else? By the way, Alan, I love your background. That's that car is like when I was in high school, everyone had that Mustang, and the 5.0 was just awesome. So it's very nostalgic for me. I very much like it. Bill, what you have a question?
Yeah, I was reading about all this small possibility of a 10% tariff on everything coming from outside of the United States. I mean, wouldn't that just add? I mean, corporations aren't going to eat that up; they're going to pass it on to the consumer. So could that turn the whole thing upside down on inflation, or what?
I think that could be inflationary, but it's also recessionary, right? So if there was a 10% tariff on every single thing, the one of two things is going to happen, right? Either everyone's just going to have to raise their prices 10%, which would be very inflationary. But in an environment where there's no stimulus, no one's going to buy that stuff, right? So if the price of that goes up 10% and people are late on their credit card payments, they don't have money in their savings account like they have the last 2 or 3 years, companies cannot pass that on anymore. The bigger inflationary story there would probably be companies, which this has been happening a lot in the last 7 or so years, are onshoring, right? Where for 30 years it was all about, ever since Jack Welch put people in India in the 80s, right? It's been all about outsourcing. The last couple of years have been more about insourcing, right? There's been supply chain problems. Other governments have been kind of an issue. So you see a lot of insourcing. If we did a 10% tariff on everything, and that what would happen is companies would say, well, we got to insource more. Insourcing more causes unemployment to drop, right? More people would be working. That unemployment dropping would be inflationary, quite inflationary. So I don't think it would be that companies would raise their prices. There's only so much room to do that. They've kind of used all of that room in the last 2 years. So I don't think they'd be able to raise them that much. But if unemployment stays at 3% and people are getting 8% raises a year to go switch jobs somewhere, that's very inflationary. And the Fed would not like that. They look at unemployment rate. They don't actually look at that much. They look at job openings a lot. And the job openings have gone from 12.5 million to 8 million. So there's already 4.5 million less jobs available in the U.S. to take today, which is why that one slide with the orange, one slide with the orange and the blue lines kind of coming down, that's why those are coming down so much in the economic section right here. Because unemployment is getting worse or better depending on your definition. Unemployment's getting higher to a more normal level where employees don't have all the power. That's very good for the economy. So if you onshore a ton of stuff because of a tariff, I could see that going the other way, right? Because people would demand huge raises and they would spend that money, and that's inflationary. I don't see that happening in this government. Obviously, we'll have a different government in a year, right? So we'll see about that. But I certainly don't think in the next year that you would see that happen. All right. Who else? Wow, two. I don't know if that means I did a great or a horrible job. But with that, we'll do as always. Joe, you have another one? Oh, no.
Yeah, just about real estate. What are the projections for real estate, home prices?
Yeah, so I would say it's stable. And
Right.
that's going to be what's been happening lately is interest rates have gone up and housing has still gone up a little bit, which usually is not the case. As interest rates go up,
Right.
usually housing goes down, right? Because of affordability. But as unemployment gets a little worse, which I think will happen, as people start blowing through their savings, which is very, very clearly already happening, that hurts housing. But what will prop up housing is interest rates coming down. So again, interest rates have already come down on the mortgages in the last 2 months. Right? I don't know if you've been watching
Right.
them. Mortgage rates have really come down a lot in the last 2 months. I would anticipate that happening, but only a little bit more this year.
Right.
So if interest rates come down a little bit more this year on the 10-year treasury from 4 to let's say 3.5, that's not going to make a big difference on interest rate on a mortgage. But then people have less savings and unemployment is higher. I would think that kind of offsets a little bit. So I don't think you're going to see interest rates, or I don't think you're going to see big increases like we've seen. There's also, for the first time in history, they're making way more multifamily than single family. So think like apartments and townhouses and stuff like that. And those, when they come online, when you build a subdivision, like my subdivision is 148 houses, right? It's pretty big. But just on like this little corner across the street from us, they're building 160 condos. Right. And it's on 15 or 20% of the space probably. So as you start to see the multifamily come online, a bunch of it comes online at once. Right. And that is going to help. That's going to help inflation a ton. Right. Because rent is the number one thing that's driving inflation today. So it's going to help inflation a ton, which again lowers interest rates, which drives the stock market. But it should also help keep a lid on housing, meaning hopefully housing therefore won't go up, because there's going to be all of this new supply of predominantly multifamily, but still place for someone to live.
Interesting. Okay. Yeah, the supply issue is still out there. Definitely in single family.
Yeah, single family homes is good. That's probably going to continue, but some people that might otherwise live in a single family home might go to multifamily if it's available or
Right.
it's cheaper.
Right.
And whether that be an empty nester or someone who just recently got married, maybe their first house is a townhouse now and not a single family, or maybe,
Right.
the 73-year-old who doesn't want to keep up their yard anymore, but might otherwise have stayed, sees that it's cheaper to go multifamily and does that. So it should, by having extra multifamily, you get relief on single family anyway.
Okay. Thank you.
Yep. All right. Anyone else? The courage to unmute? No? All right. Well, everyone, thank you so much as always. I always enjoy doing these and taking your questions afterwards. So there will be we'll place this on our blog on the website as well as on our YouTube channel if you're thinking about it and you want to go kind of remember what I had to say. Also, don't ever hesitate to reach out, whether it's to me or any other advisor that you work with at Aquest. They'd be happy to answer these questions for you. So again, Happy New Year and thank you so much. Have a great one.